Hans-Holger, can I just start by asking you about emerging markets generally? Are you worried that emerging markets are going to become more risky, and how does that impact on your business?
Well, emerging markets is a more risky business, obviously. It demands more from management, it demands more in terms of planning, and I think it's all about the kind of risk-reward balance you have to find in those markets. But like always, where there are bigger risks, there are bigger opportunities. And I think that's the interesting part we see with our business. Currency is a big issue, for sure, like during the course of this year. We have to see what's going to happen, we have to see what impact it will have, but again, this is something which is our daily bread and butter business, and we have to manage through those kind of things.
So in this most recent quarter, you've delivered growth. What's been behind that exactly?
The good news is it's in all parts of our business. We have seen growth on the mobile side. Most notably, Africa is coming back to growth in our business, which is very positive after nearly 2 years of stagnation or decline even. We've seen strong growth in South America, particularly Colombia has been very strong, and Paraguay on the mobile side. And Central America is stabilizing because the situation is a bit more complicated. But on top of that, mobile banking is growing fast, nearly doubling the revenues in 1 year. We have seen the cable business growing a double digit, over 10%. So it's not just one bucket of growth, it's all over in the company.
So you're getting overall growth?
No, exactly. This is important for us. We always say we want to be a growth company. We want to be diversified in terms of growth, and this is coming nicely together right now.
But is the rate of growth really sufficient for you to achieve your what are pretty exciting revenue targets of doubling revenue in 5 years? Are you actually realistically going fast enough?
Yeah, we're going. I think it's a combination. Don't forget about organic growth and acquisition, of which the Uni deal, of course, plays a big part. But if we come back to kind of double-digit growth, organic growth, it should be sufficient. And so far we're absolutely on track, so no concerns from my side to hit the target.
But isn't there a problem with the profit margin, with the earnings margin, EBIT margin? I mean, the question I suppose is, are you buying sales growth, revenue growth, at the expense of profit margin?
From the first look, you could imagine that, but the truth is there's an underlying structural issue in the margins. We're moving from an old high margin business, which was voice business, to a lower margin business, which is data. So this is a fundamental switch in terms of what kind of business we are running. We're entering new business, which are lower margin business, but higher cash flow generative, like banking, for example, like the internet business. And third, it's something we had to achieve anyway. The growth, we had to invest into the growth in order to sustain the margins. So the fact that the margin is not declining anymore and is getting stable is a very positive sign. So I don't think it's a kind of model where we buy growth with no margins.
Right. So you're comfortable with the way the margins are performing.
And there was no choice. I mean, that was the only way for us as a company going forward.
So have you actually fulfilled your guidance that you set a year ago?
Yeah, we have fulfilled our guidance. We didn't break it up year by year, our 5-year guidance. So we set the kind of overall 5-year target. But on the short-term guidance, which we give to the markets.
Let me ask you about online, because clearly from the results, it's tough, isn't it? It's quite a challenging place to be. I mean, is it worth you carrying on with online as a strategically important operation?
The make it or break it case for Millicom is to transform the company from a pure mobile play or mobile operator play to a digital lifestyle, as we call it, hence diversify into new business and services. And online is the biggest part, obviously, or one of the biggest part we have in the portfolio. And you have to do this kind of journey. But you need to be flexible, like always when you build new business and when you are in very challenging markets, as we said at the beginning. You need to be flexible, and sometimes you adopt strategies, or sometimes you shift investments a bit. And that is how we look at online.
We've mentioned that EBITDA margins are obviously under pressure, but the company is still spending a lot of money, and CapEx is obviously still very high. Is that going to continue, and what is it exactly that you're spending the money on?
Yes, it's in the business that the margins have been under pressure. It's the transition we have from voice, which was our old business, high margin business, to data, which is a lower margin business, much more subsidies. But at the same time, we're investing into growth. And there are many fields. There is the online business we're investing in, obviously. There is, on the cable side, the launch of Tigo Star, our DTH platform, or we start to invest into content, which we believe is very important for us as a company going forward, like Tigo Sports, for example, in those markets. We have investments in Africa, obviously, still in the network and in the operations there. So it's a combination of a changing business model we have, which brings the margins slightly down, and the investments we're doing, which we can see then results in growth. Overall, we are in line with the guidance when it comes to the margins, and overall as well, we believe that in 2014 the situation will stabilize, and that's a pretty good achievement if you have seen the underlying trend 12 months ago.
I think it's fair to say that ARPU has obviously been in decline in recent months. I know it started to rise again, but are you worried that ARPU is performing correctly, and what are the dynamics behind ARPU?
Well, it is one of the most important number we have to follow. ARPU is a key driver for us, and right now we see positive signs, and I think there are two impacts. One is the stabilization of the ARPU for voice in Africa, which had been under pressure for quite a while. And the second positive thing is that we see a very strong uptake when it comes to data. Just in the last months, we have added 100,000 new data customers every week in Africa and Latin America combined. So a pretty strong intake. And they consume data more and more, hence ARPU is going up, hence everything is getting better for us on that front. And
Hans-Holger, any news on the Unitrand transaction that you announced recently? Any update on that?
No, we have to wait, impatiently unfortunately, but we have to wait for the approval of the authorities, which we believe should come by the beginning of second quarter, most likely, but it's beyond our control. But we do all the work in preparation, of course, which we can do, but otherwise it's a waiting game right now.
And any particular priorities for 2014 for you?
Well, some of them you mentioned, of course. It's still the UNI deal, once it falls in place, is very important. Africa is still a lot of focus in terms of getting the turnaround fixed. Central America, we look at a bit more in terms of growth. And another big item for us is efficiencies, cost efficiencies, which we have to run in the company all the time as well.
So cost savings to come, presumably?
Yeah, or getting the kind of efficiency we need in order to sustain those kind of investments and the kind of speed of rollouts we have.
Okay. Great. Thanks very much.
Thank you.